what is your opinion about having an inverse ETF in the portfolio?
I'm okay with it. I mean, I wouldn't have it because they're not biblically responsible. But aside from that, I mean, they don't always work like you think they're going to work. And I always, they're unless you've got a 1-for-1 inverse ETF, then the question is, if you have one, and I'm just giving you a number here just to make a point. So if you have one and that one is, $10,000 and you have a $150,000 portfolio, who cares? I mean, the inverse reaction is not enough to pull up the rest of the portfolio. So when the market turns, you're still going to have a great deal of losses. So then you have to decide, well, do I take the chance of having far more money in the inverse so that if it is accurate and it does go up when everything else is going down, then it will pull my portfolio up and I will be even. It very seldom works like that, and things are changing dramatically. So, in other words, we are in an environment, and this is why things have been so difficult over the last 10 years. We're in an environment where the markets if the market drops significantly, everybody's bond fund is in the tank as well. Everybody's inverse ETF, not everybody's, but a lot of the inverse ETFs are in the tank. Commodities are down when stocks are dropping. That's not supposed to happen, and it does. So there's so many different things to think about. But if it is part of a very, very, very carefully thought out and well-planned portfolio with a notion that you're willing to take the risk of missing out on opportunity when things are up, and you're looking to flatline your portfolio so that basically, it doesn't go up much, but it doesn't go down much either, and I'm preserving. I would rather be in a portfolio full of CDs and government bond funds and probably just leave it at that, if that's what I'm trying to accomplish. Yeah, look, almost through the last 130 years, when you look at a 10-year period of time, you will note that the probability of loss without any inversion of funds, without any loss, the probability of loss after 10 years, 3 months is zero. It's zero. It's not 10%. It's not 20%. It's zero. So if you're a long-term investor and you have a well-diverse portfolio, then yeah, look, my IRA, I've got funds in there down. I have one that's down 70%. I've got other funds in there, not funds, but stocks that are down 40 to 60%. But you know what? I'm still positive territory. And over the last 130 years, the market has always been up far more than it's been down. I don't think that's going to change. I think that is going to continue. Now, with the exception of some event that is something totally unforeseen, a black swan, so to speak. So, I think if you're going to do inverse, I think you need to do it in a significant way. So, for example, if you have a 150,000 portfolio, you would have 50% and then 50% in the inverse, to kind of balance it out. Because if you only do 10% inverse, is not going to protect you. That right? Right. And if you do that, and it works like it's supposed to, then you're not going to have a loss, and you're not going to ever have much gain. So if you're going to do that, why even take the risk of it doing something it's not supposed to do? Just put it in a money market account and be done with it. I mean, so you know what I mean? Like there's a trade-off there. So you have to do it. I'm not saying you shouldn't do it. I'm just saying you should do it with the full confidence that the inverse, the 50% that's inverse is going to act the way it's supposed to act. You got to be pretty confident about that. And if you are, you feel good about that, then yeah, it will help you in those downturns. Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.